Hi guys, Nrupin here, and in this video we will take a look on MACD indicator, also known as moving average convergence divergence indicator. Before we take a look on how it is applied on chart, let's understand what's MACD first. MACD is price cycle indicator, and price cycle indicators are used to plot cyclic nature of prices on chart. Price cycle indicators are better known as momentum indicator subtype oscillators. Since MACD is price cycle indicator, it works similar to any other price cycle indicator. The diagram in front of you represents prices in uptrend. In an uptrend, each peak is known as bullish price cycle. While in uptrend, price cycle indicator marks beginning of new bullish price cycle. Similarly, in downtrend, each low represents bearish price cycle, and price cycle indicator marks beginning of bearish price cycle. In general, all price cycle indicators not only appear similar to diagram in front of you, but they also generate buy or sell signals similar to each other with very minor to zero exceptions. The price cycle indicator usually consists of indicator line and signal line. When indicator line moves above signal line, we call it a bullish crossover. Similarly, when indicator line moves below signal line, we call it bearish crossover. Remember, all crossovers represent entry. None of the crossovers represents exit. Exit depends a lot on your risk management and strategy used to enter trade. Next, unless crossover is followed by successful resistance or support break, entry is not considered as valid. Third, always follow golden rule of technical analysis. Always take entry in direction of trend, not against it. It is required to take entry in direction of trend because if you take entry against it, then most of your trades will have very high chances of failure. Also, majority of stop loss strategies fail to work miserably if position is taken against trend, thus leaving you with no profit or loss. So avoid entries against direction of trend. Price cycle indicators can represent both reversal and continuations. For finding reversals, divergence is used. Look at the example in front of you. It represents bullish divergence. A bullish divergence is said to be formed if price keep falling, but each new bullish crossover is forming above its previous bullish crossover. When we see this happening, a resistance break is expected soon. Entry is taken with successful break of resistance. Similarly, during bearish divergence, prices keep rising, but each new bearish crossover starts forming below its previous bearish crossover. For bullish continuation, first we wait for price to successfully break new resistance, and that resistance break should come with bullish crossover forming above its previous crossover. Same also applies to bearish continuation pattern. For MACD, signal line is calculated by taking difference between two simple or exponential moving averages. This plots the cyclical behavior of price. Now a 9-day simple or exponential average is plotted over it. This gives us signal line. The signal line plots the rate at which cyclical behavior of price is changing. The short MA aka fast MA for MACD is plotted between 12 to 14, whereas long MA aka slow MA is plotted between 24 to 28. Note that these are not just arbitrary values. They are there for a reason. An ideal price cycle is always considered to be of 28 periods, and it takes nearly 9 or 10 periods to see shift in price volatility. That's one reason why majority of indicators are modified in multiples of 7, because it is 1/4 of ideal price cycle, and when indicators parameters demand volatility, it is always 9 or 10. Remember, on real trading environment, signals will not appear as simple as they appeared in explanatory diagrams, and spotting them while chart will be forming live will be tougher than spotting on already formed charts. So do not go spending your money on trades without practicing at least for 21 days. Now let's move to the charts to see few examples. Now remember the first condition. Always take position in direction of trend. So here the confirmed trend is uptrend on daily chart. So what we will do, when we will switch to smaller time frame than daily time frame, we will take positions only on bullish entries and we will avoid all type of bearish entries. So let me switch to smaller time frame, 30-minute. You can go even smaller, it wouldn't change anything. Now let me go a little back so that I can show you multiple examples. Now here we are. So first we need a resistance break. Here we got our resistance break. As step number 2, we will check has this break came with shift in price volatility. Now since this is a gap, we will assume that the shift already happened, and since shift already happened, we will go here and check whether the new bullish cross is above previous bullish cross, and it is. And what we can see here is that price actually fell down when this rise happened, which means this is a divergence. So this is a valid buy signal. So you will buy here and keep your stop loss here, and most likely your stop loss would hit somewhere here. So you will exit in very good amount of profit. Now I told you that whenever you are taking position, always take position in direction of trend. And here is one example why you should not take position against direction of trend. Here you can see the bearish divergence. Now since there is bearish divergence, we will wait for support to break, the most recent support. Here it broke. With good shift in volatility. Now the problem here is that we do not consider a trade to be successful trade unless you have made at least 1.5 times of the profit on risk, and here your SL would have hit before you would have made the profit of 1.5 on risk. So here you would take entry most likely, and here would be your stop loss. Now here you can see it going below, but when you would be trading on this signal, you would trail your stop loss, and when this candle would have formed, this one, majority of the stop loss strategies that we use would have hit it, thus making you loss in process. Now in this case, means here if you would have taken entry, then you would have taken entry here and your stop loss would be below this candle here, and you would be exiting your trade somewhere here. Your stop loss would hit here most likely. So in all, you would have made a decent profit on a very small risk here. So always keep in mind, unless you are making a lot more profit on your risk, your trade is not considered successful. Minimum requirement is 1.5 times of the risk that you are taking on trade. So again, we will move ahead and look for a bullish entry. Again here, as you can see, there is a divergence, bullish divergence. And there is a resistance breakthrough here. With pretty good shift in volatility. Here again we will take a long position. Here will be your first stop loss. Most likely your first trailing SL would hit here, and you would exit with good amount of profit. I think it's 5 here. Now as you can see, here is the next crossover, and this is the first resistance after divergence. So when it will break, most likely here, you will get another entry on this MACD. So here again, we will check the crossover. This is first bullish crossover and this is the second one. And since this is above it, this is a valid entry. So again, you would have taken a long position here. This would be your stop loss while entering, and when you will trail your stop loss, most likely it will hit at the same place, thus making you a lot more profit than the risk you would take on this trade. Similarly, we will take further trades. Here again, we can see a bearish divergence, price moving up. But here it fell down. Break, clean break. And if you would have taken short position from here, most likely you wouldn't have made any profit because your stop loss would have hit on this candle. And though you would have made a profit less than one, we don't consider a trade successful unless it makes minimum 1.5 times of the risk you are taking on trade. So we will consider this trade a failure if it hits stop loss before actually making you that much profit. And it will always happen if you would be taking a position against trend. So keep in mind, always take position in direction of trend. Now this not only applies to 30-minute time frame. If I will switch to 5-minute time frame, it will also work in this case too. Now look here. This is first bullish crossover. This is another bullish crossover. What we need is a resistance break. So here is the resistance break, and has it come with shift in price volatility? Yes, it's a very big candle, and big candles always represent shift in price volatility. So again, you would have taken entry here. This would be your stop loss, and you would have, so this would be kind of a failed trade, but most likely you would still end up in good profit near to 1.5. Remember, secret to making more money while trading is that you should avoid signals that have high probability of failing and taking entries only on those signals that have high probability of generating you profit. Remember, there are no cheap tricks in technical analysis that could help you trade profitably without proper understanding of basic concepts. Almost all trading and investing videos that anyone have ever uploaded on YouTube are helpful only to those who already have taken proper training or courses, or at least have spent little time learning and understanding basic concepts. Honestly, you should take any NSE certified course before applying any of the techniques or strategies. It's for your own good. In case you don't want to spend a lot of time taking expensive exchange certified courses, then you can join my course on Udemy, Trade with Technical Analysis, as cheap alternative. It is not as good as NSE certified course because it is prepared as fast track course with only information required for trading, mostly for beginners or people who found NSE certified courses too difficult or too confusing to apply. With that said, thanks for watching this video and have a nice day.